Hello guys, once again welcome to our YouTube channel Edu Hub, and as you know, this part 6 of stock market investment for beginners. And guys, this is last part of this course. After this you will become a professional in this field, I mean stock market. So guys, please don't forget subscribe our channel and like and share our videos for support, because it has take lots of hard work. And now without wasting time, let's get started.
Stock Market Investment for Beginners Part 6.
So welcome to this first add-on lesson, where two of my students have asked me similar questions. Amina from Mumbai, she is Amina from Mumbai, India. She has asked me what are bonus shares and rights issue, as we often keep hearing in business news channels. Amina is an architect in Mumbai. And Jennifer has asked me that if bonus shares are truly bonus, then why does the market price of the shares fall drastically on the day bonus shares are issued? Jennifer would not like me to display her picture and her country, and I respect her sentiments. Now, while I would like to thank Amina and Jennifer for asking these questions, I would also like to extend my apologies to both of them and to all the existing students of this course, because I missed out explaining these aspects in the main course. Now, though I had mentioned about bonus shares and rights issues in one of the initial lessons, I somehow missed out explaining them in detail in the subsequent lessons. And let me do that now. Now, to understand why the market price of the shares fall drastically on the day bonus shares are issued, we first need to understand what are bonus shares, why are they issued to the existing shareholders, and what is the implication of bonus shares. Alright, so to begin with, let me clarify that bonus shares are bonus, but not a bonanza, meaning to say that they are something which belongs to the shareholders, and therefore they are being given to the shareholders without taking any price or any money from them. The bonus shares are just issued to the existing shareholders without taking any price or any money from them, and that is why they are called as bonus shares. But they are not something like a lottery, or they are not a bonanza. Let me explain this. So welcome back. We have completed 3 sections, and now I am just opening up the 4th section of this course. Alright, and I am calling it an add-on section, but it is just a beginning. Alright, I have tried to explain whatever I had to explain in this course. Whatever came to my mind as a comprehensive knowledge, I have tried to explain here. But I am reluctant to say that we have come to an end of the course, because this subject, this topic of stock market is such which can never come to an end. In fact, this is just the beginning, and therefore I have written here, let us begin. But you know, at some stage I have to say goodbye. So let me say that now, for the time being. I am not saying a final goodbye, but for the time being, let me say a goodbye to you. I have named this section, this 4th section, as the add-on section, and it means to say that as you keep asking me questions, I will keep adding my answers here, and I hope that this section will never come to an end. So what I have planned, or what I have thought of, is that as you keep asking me questions, I shall try to answer those questions in the form of small videos, and those videos I shall keep adding into this section so that everybody or all the students can take benefit of those answers. And along with the questions, first of all, I request you, I would urge you to keep asking me questions, more and more questions which come to your mind, so that I can try and answer them. And when you ask questions, if you send me a soft copy of your photograph with your name and your country, and if you grant me permission to include your details in my answers, then I will be happy to do that. I shall insert your photo, your name and your country along with my answers if you permit me to do so that let others know who has asked the questions and contributed in keeping this course alive. Alright? But before I thank you for being with me so long, I would like to make a very humble request. You see, investment or trading in the stock market is an art and a science. Learn the art, master the science. If you are an investor, be patient. The market is not going to run away anywhere. If you have invested some money in the stock market, do not lose your sleep. Be patient. If you have done your homework well, if you have done your fundamental analysis sincerely, then with time you will gain. Don't lose your sleep. And if you are a trader, try to manage your risk, or rather you must manage your risk, because in the short term, the market can behave in a very, very wonky way. Markets are not duty bound to follow your technical analysis. So therefore, if you trade in the stock market, then you should always cover your position. You should always manage your risk. Enjoy your investment and trading journey, but please never speculate. Never try to gamble or speculate in the stock market. If you speculate, the market may ruin you someday. And I pray that that day never comes. Alright? So wish you a happy and fruitful learning journey. Keep asking me questions so that I can keep answering you, and this course will keep on increasing in size and will remain live forever. Thank you so much. So we go back to the initial lessons where we had discussed about the initial public offer and the follow-on public offer and those things. All right. So just to recapitulate, you see, when the company started, it started with 10 million in the form of equity, and this entire 10 million was owned by the promoters. Initially, they had not taken anything from the public. Then after a few years, when they came out with the initial public offer, that time the equity was still 10 million, but the reserves and surplus had built up to 15 million. Because of the hard work of the promoters, the company earned profit, and a major portion of the profit was reinvested, and that is how the reserves and surplus had built up to 15 million. And then just after the IPO, once the IPO was subscribed, then the equity became 18 million. 10 million was already there by the promoters. 8 million equity they got by issuing shares to the public, 0.8 million shares of face value 10. Alright. And since they were issued at a premium, the reserves and surplus also increased. And then after 5 years of hard work after the IPO, we saw that the equity remained the same, 18 million, but the reserves and surplus increased to 150 million. Alright, so far we have just recapitulated, but I hope you are with me. So just before the IPO this year, the face value was 10, equity was 10 million, number of shares was only 1 million, alright, and the reserves and surplus was 15 million. Yeah, there's 15 million. and therefore the book value was 10 plus 15 divided by this 1. Alright, the equity plus the reserves and surplus divided by the number of shares. So the book value was $25 per share. That was the book value. And when the book value was 25, the market price was 78 per share. You remember they came out with the IPO and the IPO offer price was 78 per share. That means in the market it was offered at $78 per share. And then 5 years later, we saw that the face value was still $10 only. Face value does not change. Equity became 18 million. Why 18? Because 10 was already there. Then in the IPO, 8 million they got from the public. Alright, by the 0.8 million public shareholders, that 8 million came. And the number of shares increased to 1.8. 1 million was already there, promoters. 0.8 million the public came in. So number of shares became 1.8 million. Reserves and surplus by that time, 5 years after the IPO, had increased to 150 million. Alright, and therefore the book value became 18 plus 150, this 18 equity plus 150 reserves and surplus divided by the number of shares, that was 1.8 million. Alright, so it became $93.33 per share. The book value at this juncture, the book value was 93.33, and therefore the market price would have increased. Alright, when the book value was 25, the market price was 78, the IPO price, and since the book value has almost become 4 times, the market price would certainly have become more than 4 times. That is because of the perception. We are seeing, or the public would have seen, that the company is growing and growing fast, and therefore they are willing to pay a higher market price. So hypothetically, let us say approximately the market price at this juncture, when the reserves and surplus are 150 million, the market price has become $400 per share. Alright, so far you have understood. Now let us come back to this. Alright, the same thing. When the owner's money was 25 million, 10 plus 15, market price was 78. When the owner's money became 168 million, book value also increased. So maybe the stock price would have increased to 400. Now the point is, this owner's money, $168 million, whom does this money belong to? Whom does it belong to? Just think over. This money belongs to the owners. That means the shareholders, isn't it? So what can the company do with this money? The money belongs to the shareholders, but it is held with the company. What can the company do with this money? The company can either return this money to the shareholders in the form of special dividend. If the company feels that it does not require so much of money, then it can give that money back to the shareholders in the form of special dividend. That is permissible. Or the company can utilize that money for expansion and growth, so that the shareholders' money can grow further. Alright? And one of the way of doing this is by issuing more shares to the shareholders, the existing shareholders, without asking for any money from them. That means issue them more shares in the form of bonus shares. Let us see how does it help. Alright, this was the status which we have seen. Now let us say that the company offers bonus shares in the ratio of 1:1. That means if you are holding 1 share of the company, you get 1 more absolutely free of cost. That is bonus. If you have 1, you get 1 more free of cost. Alright, so what will happen? Just look within this blue box now. Alright, 1.8 million shares are already there. The company is issuing 1 free over 1 share, so another 1.8 million shares are issued free of cost without taking any money from the shareholders. So the total number of shares become how many? 3.6 million. The number of shares will double, isn't it? What happens to the equity and the reserves and surplus? Now see, reserves and surplus was 150 million. From that, 18 million will be shifted into the equity. Alright, plus 18 million. From this, 18 million goes into the equity. Why 18 million is going here? Towards the cost of this 1.8 million shares at the face value of $10 per share. So from reserves and surplus, that money is moved into the equity head. This is just an accounting procedure. You don't have to worry about it. Alright. So from 150, 18 million goes into the equity head. So the equity amount becomes 36 million. Earlier it was 18 million. 18 million more added, it becomes 36 million. But reserves and surplus would reduce by 18 million. From here only the money has gone from right pocket, it has gone into the left pocket. Alright. So 150 minus 18 would become 132. Now reserves and surplus have become 18 million less. Equity has become 18 million more, and 1.8 million shares have been issued to the shareholders. Alright. But what happens to the total owner's money? The reserves and surplus plus the equity, that remains the same. Alright. Because here from 18 it has become 36, 150 has become 132, but the sum of 36 and 132 still remains 168 million. So the total owner's money has not changed. It has remained the same. Alright. Therefore, what will happen to the book value? The book value will become half. Isn't it? The number of shares have increased. Earlier, this 168 was divided by 18 to get this figure of 93.33. Now this 168 is divided by 3.6 million. The number of shares have doubled. The amount or the owner's money has remained the same, but the number of shares have doubled. So what will happen to the book value? The book value will come down to half, 46.67, half of this. And what will happen to the market value? Market value, on the day the bonus shares are in the hands of the public, the market price also literally or theoretically will become half. Alright. It is something like, the quantity gets double, the quantity has doubled, the price becomes half, so the total value remains the same. Alright. You have got 10 marbles in your right pocket. Each marble is priced at $10. You take out those marbles from your right pocket, put them into the left pocket. There they become 20 from 10. The quantity double, but the value remains the same. So the price will become half. Isn't it? I hope that makes sense. Alright. So the examples of the bonus shares could be 1:1. That means 1 share for every 1 share held. If you are holding 1 share, then the company will give you 1 more share free of cost. 1:2 means 1 share for every 2 shares held. If you are holding 2 shares, then you get 1 share free. A ratio of 2:1 means 2 share for every 1 share held. If you are holding 1 share, you get 2 shares more. So you get total, it becomes 3 in your hand. Alright. 6:11, just an example. This means what? That 6 free shares for every 11 shares held. If you are holding 11 shares, you get 6 shares more. So depending upon how the company wants to distribute, how much it wants to convert the reserves and surplus into equity, depending upon that, in any particular ratio, the company can issue bonus shares, and accordingly the market price will get adjusted. Alright. Here, since the quantity had become double, the price or the market price had become half. But accordingly here, depending upon how the quantity increases, the market price will adjust so that the total value remains the same. Alright. But now you will ask me that if the market value, the total value of the shares remain the same, then what is the benefit of bonus shares? So now let us have a look at what is the benefit of the bonus shares. Now, as we have seen in the previous part, that the market price of the shares will fall on issue of the bonus, so that the total value of your holding will remain the same. Alright, then what is the benefit? The benefit is only in the positive change in perception and sentiments of the people. The benefit immediately is not in terms of price or the market price of the share, but it is in terms of a change for the better in the perception and sentiments of the public. Number one, issue of bonus shares will send a message that the company wants to increase the shareholder base, or the number of people holding the share of those company will increase. That is a positive sign for the company. Then it increases the liquidity. More shares are available in the market at less price. Earlier 1.8 million shares were available at a market price of $400 per share. Now 3.6 million shares are available at half the price, that is $200 per share. So more number of shares are available at less price. That means liquidity of those shares have increased twice. Alright. Then it gives a good feeling of holding more number of shares. Before the bonus issue, I was holding only 10 shares. After the bonus issue, I am holding 20. So it gives me a good feeling that I am holding more number of shares. And since the price comes down, more retail investors or the small time investors are able to purchase those shares. When the price was 400, common man, or the service class people who are earning less, may not be able to afford those shares, though they are good. But when the price has become half, people will think of purchasing them. So more number of common people can purchase those shares. Then the shareholders get dividend on more number of shares. Say earlier, if the company gave a 50% dividend and I was holding say 10 shares, face value $10 each, I would get a dividend of $5 on each share. So on $10 I would get $50. Now I am holding 20 shares, so I will get $100 instead of 50. The amount of dividend which I get will increase. Alright. And then it gives a sense of growth to the shareholders. By increasing the number of shares in their portfolio, it gives them a psychological feeling that their holding or the number of shares in their portfolio is increasing. Though it is a pseudo feeling, holding 100 shares valued at $400 per share or holding 200 shares priced at $200 per share is the same thing in terms of money. But in terms of feeling, it gives a very positive feeling that I have more number of shares in my portfolio. And ultimately, all these factors are improving the investor confidence in the company, improving the sentiments. Alright, and all these change the perception of the public, the sentiments of the public. All these things will ultimately increase the demand for the shares of that company. The demand will increase, and therefore because of the demand, eventually the price of the shares will also increase. So you got the point. The price of the shares will immediately not increase upon issue of the bonus. The price will in fact come down, but with passage of time, with improvement in sentiments, with increase in demand because of improved sentiment, the price of the shares will increase further. I hope I have made myself clear on the bonus issue of shares. Alright? Alright. Now we shall talk something about splitting of shares. Now this is Faiza from Mumbai in India. She is a professor in one of the colleges there, and she has asked me a question. She says that she has heard her friend saying that the company where she had invested her money, that company has split their shares, and in return she has got many shares. So Faiza wants to know what is splitting of shares and what is the implication on the shareholders' money. Thank you, Faiza, for asking me this question, and let me explain it now. Now let us talk of the rights issue. Alright, this was the question by Jennifer. Let us talk of the rights issue of shares. Now you may have heard that a company is offering rights issue of shares in the ratio of 1:1 or maybe any other ratio at an offer price of face value plus $290 premium. That means the offer price of $300, while the market price of the share is $400 per share. Alright, in the market the share is available at $400, but the company is offering rights issue at $300 per share. Now the point is, what does it mean? Rights mean your entitlement or something on which you have your claim, something which you can claim as yours. That is your right. Alright? And who has the rights or the claim over the company's fortunes? It is the owners or the shareholders of the company, isn't it? Other public who are not the shareholders, the outside public, does not have any right or any claim on the fortunes of the company. It is only the existing shareholders, that includes the promoters and the public shareholders, only they have got the rights over the company's fortunes. Therefore, only the existing shareholders of the company are entitled to get the rights issue and not the outside public. Alright, the bonus shares were also given to the existing shareholders. Similarly, the rights issue is also meant for the existing shareholders. But what exactly is the rights issue of shares? What exactly it is? To understand that, let us go back to these figures. Number of shares 1.8 million, equity 18 million, reserves and surplus 150 million, total owners money 168 million, this 18 plus 150, book value 93.33 and the market price 400. Let us imagine this situation of a share of the same company what we are talking, Five Friend Garments Limited. Alright, now let us say that the company wants more money for expansion project. The company wants to expand, build more assets, more plants, more machinery, and it wants more money. It has $168 million as on date, 18 of equity and 150 of reserves and surplus, but that 168 is not enough. The company wants more money. So what can the company do? How can the company get more money? The company can either borrow money from the bank or other lenders. Now this is called as debt. The company will have to pay interest on that debt. This may not be acceptable to the company at this stage. The company is doing very well. It may not want to borrow from the lenders. What is the next option? It may issue shares to the other public, the follow-on public offer. Initial public offer is already over. The company can again come up with a public offer, which will be called as the follow-on public offer. In that, the company will offer shares to the other public. Anybody can buy those shares. But the company may not want to do that. By doing that, it will invite other people to become shareholders. And then there are so many things. The company may have to, since the market price is 400, the company may have to give out the shares at a little lesser price. Then only more public will come. So the company will evaluate the pros and cons, and the company may not want to go on with a public offer. Alright, so what is the third option available to the company? The company can reward the existing shareholders, the current shareholders who are already holding shares of the company. The company can reward them by offering them additional shares at a discount to the market price. In the earlier lesson, we saw that the company gave it free of cost. Alright, that was the bonus shares. But in that case, the company did not get any additional money because that was a free issue. Now the company wants more money. So therefore, the company can give shares to the existing shareholders, not free, but at a discount to the market price. That is called as the rights issue. So you have understood the difference between the bonus issue and the rights issue now. Alright. So let us say this is the stage. Alright. Say the company is offering rights issue in the ratio of 1:1 at a face value of 10 and a premium of 290. That means if you are holding one share of the company, then you are entitled, or you have got the right to get one more share at a price of $300. $10 is the face value plus $290 as premium. That makes $300. While the market price of the share is at 400. Okay, and you are getting it at 300. So in true sense, actually this is the bonus. But no, this is not called as the bonus. This is called as the rights issue. Alright. So what happens now when the company gives one more share at a premium in the form of rights? 1.8 million number of shares were there. Now they become 3.6 million, because for every one share held, you are getting one more as a rights. Isn't it? And what happens to the equity? The equity becomes 36 million. $10 face value. Alright. And the same number of shares issued, 1.8 million. So it becomes double. From 18 million, the equity will become 36 million. Got the point? I hope there is no doubt, no confusion. What will happen to the reserves and surplus? The reserves and surplus, now out of this 300, $10 is the face value which goes into the equity. Remaining 290 is the premium. The premium goes into the reserves and surplus. Alright. 290 into 1.8 million additional shares being issued plus 150 which is already there. So the reserves and surplus now becomes $672 million. Earlier it was 150 million. Now it has become $672 million. What had happened in the previous lesson in case of reserves, in case of bonus issue? In case of bonus issue, the money was just transferred from reserves and surplus into the equity. This amount did not change. The total owner's money had remained the same. But now you are getting additional money. So the total owner's money will become how much now? 36 is the equity plus 672 is the reserves and surplus. So owner's money now becomes 708 million. It was 168 million earlier. By giving rights issue to the current shareholders, the reserves and the total owner's money has become 708 million. I hope you are understanding what I am trying to say. Alright. And what happens to the book value? You see, earlier this book value 93.33, how did we arrive at that? The owner's money 168 million divided by the number of shares, that is 1.8 million. That gave us 93.33 as the book value. Now the book value will change. The owner's money has become 708 million. Number of shares have become 3.6 million. So 708 divided by 3.6. The new book value will be $196.6 per share. Alright. So the book value has increased. The number of shares have also increased. What will be the new market price? This we do not know. Unlike in the case of bonus shares, where we could say with certainty that since the number of shares have doubled, the market price will become half. That was because there was no additional money which had come in. Alright? But here in this case, additional money has come in. So we do not know whether the market price will increase or decrease. It will all depend upon the perception of the public in general. If the public and the investors and the traders in the market feel that the company has done a good thing, a company has done a right thing, a fair deal, in that case the market price may increase. But if the public and the investors and the traders in the market feel that this rights issue was not a fair game by the company, in that case the market price may reduce. Alright? Like the bonus issues, the rights issue can also be in different ratios. What we talked earlier was 1:1. That means for every one share held, you get one bonus share or one right share. It can also be 1:2. That means one share for every two shares held. If you are holding two shares, then you are entitled for one share as a rights issue. Or it could be 2:1, like two shares for every one share held. If you are holding one share, then you are entitled to rights of two shares. Or it could be any other ratio like 5:14. That means if you are holding 14 shares, then you are entitled to get 5 shares as rights issue. So there could be various combinations. Alright. So I hope the concept of bonus shares and rights issue of shares is now very clear to you. You can watch the lessons once again, and still if you have any questions, then you can always contact me. You see, it is very important to understand these things for a broader perspective of the stock market, to understand things in more clarity so that you can take decisions in the correct perspective. If you just happen to deal or trade in the stock market without knowing these things, then you are likely to go wrong in your estimates or in your assumptions or calculations. So therefore, you must remember all these things. Alright? Before I explain the splitting of shares, let me narrate to you one of my memories from the school days. You see, near my school, there was a baker's shop selling fantastic cakes, very delicious cakes he used to sell, but they were quite expensive. They were worth the cost, but still for me they were expensive. In terms of Indian rupees, if you say it was 700, so approximately about $10 for the full cake. I neither needed to purchase the full cake nor I could afford it. And several of my friends also wanted to eat it, but they could not afford. And they did not want to buy the full cake ever. Alright? Even the baker was unhappy because not many cakes were sold. Despite being good, despite being delicious, despite being extraordinary cakes, very few could be sold during the day. So one day that baker split the cake into 10 pieces, each piece costing $1. And when he did that, me and my friends rushed to the shop. We could just afford to buy one piece each for a cost of $1. So what actually the baker did was, he increased the sellability of the cake by splitting it into pieces. Many people could now afford it. Many of my friends could afford it. So we all used to buy it, and eventually the sales of the cake increased. Earlier few could be sold during the day. Now the baker was able to sell many. Something similar happens to the shares of good companies. When a company is launched, normally in the first year of their functioning, normally the face value would be $10, the equity would be a small amount, maybe say 10 million. And because it is the first year of working, they would not have any reserves and surplus. So the book value and the market value would also remain somewhere around the face value, and the share may be considered as cheap. But as time passes, as the company grows, earns more and more profit, their reserves and surplus would increase. And after several years, the price or the market price would increase because of the increase in reserves and surplus. Now it may be called a good share and also affordable. But with further passage of time, the share tends to become expensive. It may be good. The company may be performing very well. Everybody may be wanting to buy the share. But still, it may be expensive for the common people to afford. And after a few more years, when the reserves and surplus builds too much, the share would become very expensive. It may remain worth the price. It may be an excellent company, an excellent share, but still it may be unaffordable for the common man. Alright, so something similar has happened to the company which we have been talking about, Five Friend Garments Limited. Their shares have now become $400 per share in the market, as we have seen in the previous lessons. They are worth the price. They are excellent. They are good. The company is performing very well. No problem in that. But still, as a common man, I do not have that kind of money to buy such costly shares. I can't afford to buy even one. Alright. And at the same time, on the other hand, my friend John, he has got a few shares. And incidentally, he needs some cash, about $150, to purchase a gift for his wife day after tomorrow. If he goes out to sell the share, he'll have to sell at least one full share. And he's reluctant to do that because he just needs about $150. So he is not selling the shares, not giving a gift to his wife, unfortunately. Because of the high price, the shares are not being traded frequently. Though they are good, they are worth the price, but they are not being traded frequently. Alright. So what the company does now? The company decides to split the shares from face value $10 to face value $1. That means anybody who is holding one share will now get 9 more shares. And the face value of all the 10 shares, including the one which he is holding, each of those shares will now be having a face value of $1. So 10 shares with face value $1 each instead of one share with face value $10. Alright. So now what happens? Face value becomes from 10, it becomes 1. And number of shares by the company were 1.8 million. So now they become 18 million shares. Alright. Equity remains the same. Earlier it was 10 multiplied by 1.8 million. Now it is 1 multiplied by 18 million. So equity remains the same. Reserves and surplus also remain the same. So total owner's money also remains the same. Nothing has changed. But the book value becomes 1/10 because you see the face value has become 1/10. So the book value will also become 1/10. I was having one share with the book value this much. Now I will be having 10 shares with book value this much. So nothing has changed. Market price would become 1/10. Earlier for one share it was $400 because the book value was 93.33. Now the book value has become 9.33. So the market price has become $40 per share. Alright. So now John can go out, sell off 4 shares, get $160 and buy a present for his wife. and I have been wanting to buy the shares from a long time, so I can go out, spend $200, and now I can afford to buy 5 shares of that company. Earlier I could not afford even one, now I can buy 5 of them. Got the point? So what has changed by splitting the shares? Practically nothing. Earlier it was 1 share with face value 10. Now it is 10 shares with face value 1. So number of shares 10. Market price came down to 110. Total values remains the same. It could have been split into 5 shares of $2 face value each. It would have meant the same. 5 shares, market price would have been $80 per share. Total value would have remained same, $400. Or it could have been split into 2 shares with face value $5 each. Again, nothing would have changed. It would have been 2 shares with market price $200 each, the value remaining the same. So nothing has changed, but still splitting of the shares have got some implication, like the splitting of the cake. What will happen now? Common man can buy and common man can sell them now. Earlier it was the prerogative of the rich. Now even common man can indulge in buying and selling the share of this good company. Alright. It has become affordable to many. So many people would want to buy the shares. And similarly, those people who may be wanting to sell small portions can now sell them easily because it has split. Alright. Like John, we can see some people who may be wanting to sell off small portions can sell them. What has happened is that the tradability of the shares has increased. And because the tradability or the marketability has increased, so the demand will increase. And because the demand will increase, eventually the price of the share will also increase. Why will the price increase? Not because of the fundamentals. Fundamentals have not changed. But because of the increase in demand, because of more and more people wanting to buy and sell those shares, the price of that share will increase in time to come. So in future, in times to come, the shareholders will benefit. How will they benefit? Because of the increase in price of their shares, the value of their capital will grow. They will not immediately benefit upon splitting, but in due course, because of the increase in demand, the price will increase, and because of the increase in price, the shareholders will benefit. So I hope you understand what is splitting and what is the implication of splitting of the shares. All right. Let us take on the next question. Now this is Hamza, who lives somewhere in central India and works for a multinational corporation or a multinational company. Hamza has asked me a question. He says that when a company declares dividend, we hear about record date, cum date and ex date. What are these dates? Can you please explain? Thank you, Hamza, for asking this question. It is my pleasure to explain this. But before that, let me tell you that there are certain dates which have a common meaning for all type of shareholders entitlement, not only dividend, but for other entitlements, be it dividend or bonus shares or rights shares, rights issues, or any other entitlement. There are some dates which have a common meaning. All right, let me explain. So whenever a company wants to give any entitlement to the shareholders, like dividend or bonus shares, rights issue, any other thing, please remember that whatever the company is giving you is basically your entitlement, the shareholders' entitlement. Company is only giving to its shareholders what rightfully belongs to the shareholders. The company is not generating anything from thin air and giving it to the shareholders. It is something which already belongs to the shareholders. All right. So, but before giving, somebody has to propose, like the majority shareholders or maybe the management, or maybe the promoter, somebody has to make a proposal. Somebody has to propose that we want to get this thing or we want to give this thing, some proposal. All right. But this proposal is only an idea. A proposal does not become binding because the company does not belong to one person. It belongs to the shareholders, all the shareholders. So a small group of people who are proposing cannot make it binding. But after the proposal is made, then there is a shareholders meeting and the shareholders decide by vote. You see, every shareholder has got a voting right. If you hold one share, the weightage of your vote is 1. If you hold 1 million shares, then the weightage of your vote will be 1 million. So depending upon how many shares you are holding, you are entitled to cast that many votes or that much of weightage of votes. All right. So if a majority of the shareholders agree to a proposal, then that proposal is said to be approved and it is announced or declared to the public. That is called as the announcement date or the declaration date. We'll talk about this in detail. I am just broadly explaining to you. And then once a declaration or an announcement is made that we are going to give you such and such entitlement, then there has to be a cutoff date for the eligibility. Because you see, the shareholders will keep on changing. This moment the share may be in your hand, you sell it off, so it goes into the hand of the other person. The other person sells it off, it goes into the hands of a third person. So the shareholders will keep changing. Who should be entitled to this benefit? The person who is holding the shares on a particular date, and that is called as the record date. This also we'll discuss in detail. And then this entitlement, whatever is declared or announced, whether it is dividend, bonus, rights, whatever, that has to be paid or given to the shareholders on some particular date. That date is also decided and that is called as the payout date. All right. There is something more to it. Let me explain these dates to you in detail with the help of a timeline or a calendar like this, and I'll do that in the next lesson. All right. Now let us try and understand these dates over this timeline or correlate them on this calendar. All right. So number one, what we said is somebody has to make a proposal. So that is called as the proposal date. All right. Let us say that 2nd of December 2021 is the date on which the proposal was made. The proposal would be normally made by the management or maybe the promoters or maybe one of the majority shareholders. And the proposal may be for a dividend or bonus or rights, whatever it is. All right. At this stage, at the proposal stage, how much is the entitlement or how much bonus or how much dividend will be given, that is not yet known. It is just proposed that something like this will be given or proposed to be given, but how much is not known. All right. But the market will start reacting to that news. The market will perceive that proposal as either good or bad. There are always two sides of the coin. Some people will perceive that proposal to be good for the company, good for the shareholders, and they will react positively. While some people may consider it as not good for the company, not good for the shareholders, and they